Well, good afternoon and welcome to this edition of Finweek Money Matters, the show that helps you manage your finances. I'm Samantha Loring. Now, coming up on the show today, we'll take a look at the role of foreign CEOs in leading JSE-listed businesses and major parastatals. We've got Johan Redling-Hayes from Heidrich and Struggles SA and Debbie Goodman-Byatt from Jackhammer Executive Headhunters joining us for that conversation. We'll get some insight into low-cost indexation and ask more than just weather index tracking products are cheaper. We'll have Stephen Nathan from 10X Investments and Narina Visser from Nedbank Capital joining that conversation. We'll take a look at women in senior leadership positions in the country and look at the global economy and what's in store for South Africa in that context. Of course, you can send us any comments or feedback to moneymatters@abn360.com. And of course, you can also find Finweek on Twitter as well as myself and Mark Ashton. Well, ever since Coleman Andrews took 200 million rand plus to leave SAA, South Africans have been very skeptical about the role that foreign CEOs have played when it comes to leading JSE-listed businesses and, of course, major parastatals. However, Steve Ross at Edcon has proved that there is a clear-cut case for foreign skills, and this creates an interesting dynamic in South African business. Appoint the best person for the job or develop local skills. This is the focus of Bruce Whitfield's Finweek cover story this week. Welcome, Johnny Foreigner. For more on this, we've got Jessica Hubbard. She'll be joining the conversation later, but Simona Levitt from Finweek, Johan Redling-Hayes, chairman of Heidrich and Struggles SA, and in our Cape Town studios, Debbie Goodman-Byatt, managing director of Jackhammer Executive Headhunters, joining the conversation. Debbie, thank you so much for joining us today. So, just running through the list, I mean, it's more than just Steve Ross. We've got Ian Woe, who heads up Woolworths now, David Neal of Clicks. Then of course there's a lot of other CEOs in South Africa that are of foreign descent. Just from a kind of broad view right now, do you think it's a good thing or a bad thing that we have foreign CEOs in South Africa?
Look, I think that it's neither good nor bad. I think it's a market reality. Shareholders want returns, and in order to do that, they need to make sure that they have the right person in the key role, being the CEO or very senior executive roles on a board. And so when it comes to choosing the next successor to a sizable organization of a market cap, of which there are very few in this country, one sometimes needs to go abroad in order to broaden the horizons, in order to broaden the pool of potential talent.
Pick n Pay is the latest appointment from abroad coming through from Tesco in the UK. So basically what you're saying, Debbie, is national borders are becoming irrelevant when you're looking for the best person to lead a company that wants to be globally competitive.
I wouldn't say irrelevant. I think there's absolutely, certainly value that one can add if one comes from a local market. But I think that the borders are blurring, and I think many organizations are recognizing that ultimately what matters is bottom line, growth of companies, and we're straddling both a local market and a global market. Companies are needing to grow. They're needing to continue to deliver shareholder return in an ever-consumptive market in many respects. And so just having only the local market to choose from is becoming too narrow for many organizations.
Johan, one of the questions that Bruce Whitfield posed is, are South African companies inept at developing local talent and internal succession planning? What are your thoughts on that comment?
I don't think that that's a question that we even need to address at this stage, because the international market for leadership talent works internationally. So the borders are flat all around, exactly as has been said. I don't think we need to worry about whether a local person is being developed for something or not. Internationally, people move from country to country, and it's not an issue. Why are we concerned about this?
So you don't think that there's an issue when it comes to internal succession planning? Because I know for the likes of SAB Miller, you know, they've got great plans when it comes to ensuring that if someone steps away, there's immediately someone to step into that role. But generally, what is your experience when it comes to creating talent from within?
SAB is a very good example of a top company that does develop people from inside, and just about every company that we ever talk to wants to appoint somebody from inside the business and certainly inside the country, because it's expensive to go outside. But if they can't find the talent inside the company or inside the country, they're business people. They're not here for some political agenda. They want to make the company effective, and you get the top talent. That's the way to do it.
Mm-hmm.
What particular skills and attributes do the foreign CEOs add to a local market?
You mentioned earlier David Neal from Clicks,
yeah.
and you mentioned one or two other people. The new man at Pick n Pay comes from Tesco. David Neal came from Boots. I don't think it's particular leadership of any unusual degree, because South Africans have produced wonderful leadership. If you look at people like Marius Klopper, for example, of BHP Billiton, and some of the others, Mick Davis has been mentioned a couple of times, and Ivan Glazenberg. So we're not short of leadership.
And two sides to the coin. Just as much as we import international talent, we're also exporting our talent.
Exactly. But I think deep experience in a particular industry is something that is very valuable. The man who goes to Pick n Pay comes out of Tesco. David Neal came out of Boots. The man who's gone into Sasol, David Constable, comes out of a major international company. So I don't think we should be concerned about this. They bring skills, they bring knowledge, and I think it's good for us.
Debbie, what are your thoughts on the political aspect of it? And of course, this comes hot on the heels of the fact that Cynthia Carroll now resigning from Anglo American, and we're looking for a new CEO there. Susan Chibangu saying that government would prefer someone who is local and of course would put South African interests first. We know the PIC have also made their views heard when it comes to hiring a local candidate. How much does politics play a role when it comes to hiring locals over foreigners?
Look, let's face it, politics is going to play a role, particularly in the hot areas that are currently in the limelight, particularly resources. I think at the end of the day, due consideration is absolutely going to be given, and a strong attempt made to find a local South African, preferably a black South African, to take the top job. But at the end of the day, the best person for the job is going to be chosen. And that hopefully will be a black South African, and if not, then there will be a fair competition, I believe. So I agree with Johan. I think that politics at the end of the day is a consideration, but not the raison d'etre, and certainly not the reason to put somebody in a top job. Ultimately, one needs to be delivering value, and it's commercial issues that will take the fall.
Yep. Is it ultimately that in South Africa? I mean, at the end of the day, is it the bottom line that they're going to put forward, or in South Africa is it a different case?
For all the reasons that we know, previously disadvantaged South Africans were not brought up through the ranks of major companies. So there's a tremendous shortage of people with that background who have the expertise and the experience to run big businesses. So the PIC and ANC, of course, have tried they've tried everything to try and put black South Africans into top jobs, but it's not always worked. And so, in fact, it's backfired on occasion. And I think we're doing the country and that population group a disservice by forcing the issue instead of having people who have the skills that we're looking for.
You know, just looking at the numbers, I mean, when you look at the value that companies like Edcon have extracted from having the experience of Steve Ross. I mean, annual sales quadrupling, you're looking at him, you know, acquiring CNN Boardmans during this time. Questionable there, but adding 500 more stores, and Edgar's is, you know, the largest retailer in South Africa. So they really do bring on their skills, and it shows and it adds value and creates new jobs in South Africa. So it filters through. Question is, why are we so defensive about this? Why are we so worried that we should have somebody from an international background to come into South Africa? I don't think people in America or England or Germany or even Australia worry about appointing people from other countries. Because jobs are such a problem here. Yeah.
And I think we have to be very cautious about the idea of a foreigner not having a focus on making sure that the local people on the ground actually benefit from them. I think there's a lot of skills transfer that can happen within the company itself, from being able to leverage the skills and experience of an international person. And then it's also not to say that a South African CEO necessarily has South Africans at heart. We've got a number of instances in smaller companies where, there's been schemes that perhaps have, left South Africans actually in the lurch. So it's not to say that foreigners don't think about their impact on the South African economy. If you look at Ian Kirk, for example, head of Santam, what we're seeing there is that they've adopted municipalities. So the company is actually taking an active role in South Africa, despite the fact that he's Irish.
Yeah. And his brother also coming through and heading up the JD Group. Debbie, what are your thoughts on why foreigners like South Africa as a place to come here and head up a large company in South Africa? Because, just looking traditionally, we are a land of expats. I've got foreign blood in me. I'm sure many South Africans can say the same. So, what do they see about South Africa that is advantageous when it comes to moving here?
Well, look, I think we all know the answer to that. And certainly, if they can be based in Cape Town, as I am, I think that the answer would be doubly clear. Absolutely, South Africa presents a wonderful lifestyle for individuals. There's a great opportunity for expats who are in South Africa to use the South African experience as a launching pad, a further development opportunity. South Africa is the launching pad into the rest of Africa, and so gaining exposure into that market is incredibly valuable experience. I just wanted to go back to something that was mentioned about all these foreigners and all these expats that are in all these companies in South Africa. Just on an analysis of the top 50, and of that there are only 90% are, 90% in fact are South Africans. It's only 10% that are foreigners. So I think one also needs to take a little bit of context, perhaps broader than the top 50. Yes, absolutely. I'm not saying or not diminishing the issue, but I think we should also be cautious about taking it too far overboard.
But it is a good point, the fact that we do have highly skilled individuals coming into South Africa and helping to upskill local South Africans and I suppose, impart their knowledge and build up companies and create more jobs. So on that note, we'll leave it there. Thank you so much for joining us. Johan Redding-Hayes, Chairman of the Heidrich and Struggles SA, and in our Cape Town studios, of course, Debbie Goodman-Byatt, Managing Director of Jack Hammer Executive Headhunters. Time now for a look at the Finweek Trade of the Week. Well, this week's Trade of the Week, the new Investec Golden ETN. Tell us about that, Simona.
Well, now that we've had the US elections, we've at least got some surety on who the next president is. Unfortunately, going forward, we still see quite a lot of risk coming through into the markets. We've got the looming fiscal cliff that's on the horizon. So I think the
never-ending Eurozone crisis.
The never-ending Eurozone crisis. I think there's certainly enough scope there for markets to still be quite uncertain. And in order to capitalize that, I would look at entering into gold trade. The benefit with the Investec ETN is that it takes out the uncertainty of the rand because it's focused on the dollar price of gold. So you don't need to make a call on what the rand is going to be doing over the next few months. But I think gold is definitely going to be a play. I'm expecting with inflation concerns coming through, we're still waiting for the effects of the drought in the States to come through into the inflation numbers. It looks like countries around the world are still looking to devalue their currencies. So I think that gold is going to be a play. So
and they say Obama is going to be good for gold.
Absolutely. Obama, I think very strong sentiment there. Good for gold. More
dovish Fed coming through, and of course then lower interest rates. But thank you so much for that. Time now to pay the bills. We'll be right back after this short break. Welcome back. Low-cost indexation is a hot topic at the moment, with government actively looking to tackle asset manager fees, which eat into longer-term returns for savers. Now, the debate is rapidly moving beyond the simple question of whether index tracking products are cheaper, but it is now looking at the entire value chain, that's including platform operators, to bring these costs down. Finweek tries to ascertain where the costs lie and what steps can be taken to reduce them and make it more attractive for investors to save. For more on this, Jessica Hubbard from Finweek Finweek, and Narina Visser, Head of Beta Solutions at Nedbank Capital. Thanks so much for joining us, Narina. So when we talk about low-cost products, typically what type of products are we talking about?
I think it's immediately associated with not necessarily just index tracking, but maybe any passively managed product. And although ETFs are known to be index tracking products, we must also remember that index tracking does not only come in the guise of ETFs, but also you can find an index tracking unit trust, and of course within the institutional space, index tracking segregated mandates. So those would probably some of your lowest cost, just if you're looking at the cost of the product itself. But that's not the only cost that is associated with investing, and I think that's exactly what government is trying to get at, is that we like to think in terms of three types of costs associated with it. There's the product cost. Then there would be the cost of acquiring the product or distributing the product, and I think that's where the platforms come in, or your stockbroking charges, or those sort of things. And then the third type of cost is your advisor fee, or in the institutional and maybe in the retirement fund space, your consulting fee. Really the advice component that says which is the appropriate product. And the advice which is given should be completely independent of the product that is chosen, and completely independent of the distribution platform or the distribution means that is used.
But it's not at the moment.
It isn't at the moment, and I think that is certainly one of the things that we are already seeing this changing internationally, and I think one of the things that government really would like to see changing in South Africa as well. It really is the shift from going from a fee-based income basis for advisors to an income-based or an advice-based fee. Really.
So performance-based?
No, not performance-based at all. It really is saying that being a financial advisor means that you're offering a professional service, just like a doctor or a lawyer or a car mechanic is doing, and that the user should be, or the client should be, paying for the professional service that is being rendered, and not being paid via a commission of the product. I could equate it basically to saying that the drug company of the medicine that the doctor prescribes to you is supposed to refund the doctor for the medical services rendered.
So depending on what type of medicine you buy, depends on how much you pay the doctor. And that of course doesn't make any sense.
Exactly.
But the problem seems to be that clients of financial advisors don't know that the costs aren't separated. Those fees aren't put up front.
Yeah, I think as much as one tries to be transparent in these costs, they are not comparable on a like-for-like basis. Because I think what you find is the most common distribution platform for retail investors in particular would be your list platforms, your linked investment service provider platforms, and each one of these have got their own way of breaking down the costs, and they would all say that they are extremely transparent and that they're doing it exactly according to the book. But the problem is that they're not comparable, so it becomes very difficult for an individual user to do a comparison of these costs. Maybe not too dissimilar from bank charges. We all know how difficult it is to really do a fair comparison. Also because it really does depend on who you are and what are your unique requirements. Do you want to run a debit order? Are you a small regular investor or a once-off lump sum investor? Because all of these things impact the overall level of costs that would be associated with your investments.
Well, we've got Stephen Nathan, Chief Executive at 10X Investments, standing by from our Cape Town studios to give us his views on the issues around cost. Stephen, thanks for joining us. So Narina talking about three costs here: product cost, the cost of acquiring the product, that of course includes the platform, brokerage fees, etc. And then of course the advice aspect, the advice, financial aspect advice. Where do you see the opportunities to bring down costs quite considerably in South Africa? Where's the obvious space right now where costs are just too high?
Well, I think it's the issue is the aggregate cost you're paying for your product and your service. So if you go back to basics, people have an investment need and they want solutions and not products. And the more choices and options you give them, then the more you disempower people because they don't understand them. They need advice, and then that advice, as Treasury has said, is often conflicted, and advisors tend to steer you in products that have the highest margins. So you can either work it from two ways. The one is you can say, well, the industry needs to provide more simple solutions to clients, or the other way is for the clients to be able to be self-directed and empowered to make their own decisions. And I think both of those are big asks, and really what Treasury is saying is that we need to get more involved to bring the two closer together, because we haven't seen any improvement from the industry in aggregate, and Treasury has been talking about these issues for more than 10 years now.
So then, I mean, where are we when it comes to regulating this? I mean, are we ever going to get to a situation in South Africa where, in fact, they're kind of penalised if they don't? I mean, what is the option here when it comes to regulation?
Well, I think that we hope the regulator will step up to the plate. I mean, Treasury last month put out some hard-hitting papers, and they identified several poor industry practices as impediments to people achieving adequate income in retirement. And they spoke about lots of investment choice, the complexity of that choice, the conflicted advice that goes with the choice. And when they looked at the portfolios, people had very similar portfolios despite all the complexity and the choice and the fees that they were incurring. So Treasury is saying we need simplified products, solution orientated, much lower fees and more transparency. Now, a lot of people, and Narina mentioned this, there is a feeling that disclosures improved dramatically. We at 10X don't see that. I've seen lots of quotes for big pension funds that don't disclose all the fees. So a lot of the issues that Treasury has highlighted actually are phase issues. And phase is a regulation that is there to protect investors, to ensure that they get unbiased advice, so they get appropriate advice. There's fee disclosure, they understand fees, and also importantly, not only do you understand what a 3% fee means, but it's fees in the context, because a 3% fee sounds innocuous, but when you compare that to a long-run real return, the return you should expect after inflation is only about 5%. So 3% in fees is not 3%, it's actually 60% of your real return, and over time that compounds to erode 75% of your long-term wealth.
So of course Treasury's come out with this paper, they've highlighted the issues, they've been talking about this for 10 years, as Stephen says. What are your views on the solution to the problem?
I think it talks very clearly towards the low-cost product which is offered by index tracking solutions. So in terms of product cost, I don't think there's much fat left in the system. There wasn't a lot of fat to start off with. These are your low-cost product solutions, so I don't think there's a lot that can be done in that end. I think the real difference can still be made in the distribution channel, and in terms of how they are acquired, and in terms of the advice as well. And I think it's not just related to the investment industry, but even if you look at things like if somebody wants to save through a debit order, for example, in some instances you might find that the debit order might run at R3.50 for a debit order. If you're only saving R100 a month, that's 3.5% of your monthly investment that goes towards just the debit order. It's got nothing to do with your investment. So I think there are hard questions to be asked of everybody in the value chain, and every single component of the value chain needs to assess and be able to justify the role that they play, and that the fee that they earn from it is justified within the context.
Yeah, I mean, but you just talk about debit orders. I mean, I don't think the banks are going to stop that.
No, but I think what it does mean is, and Stephen has certainly pointed out to it also, is that there are ways in which one can facilitate bulking maybe. Even if you do it, for example, through a corporate payroll, and I think this is exactly where government is also looking towards savings towards retirement to become a different specimen or a different model that we need to look at. So one needs to differentiate between compulsory money and voluntary money. So compulsory would relate to your retirement savings, and if you are part of in the formal employment, there would be some sort of formal retirement funding that you're familiar with. But if you're not, then how do you save towards your own retirement? But even then, within the voluntary funding space, it's also a case of how do you actually maximize the investment and the savings component of the little bit of money that you do have available. We're a saving short country, and how do you actually encourage that? Certainly not by running a debit order where your debit order actually ekes away.
There has to be an incentive, and for those clever people who do realize that after inflation they're not getting a lot back, you need to create a better incentive.
Definitely.
Stephen, what are your thoughts on the cost of trading on the JSE relative to other international stock exchanges?
I don't have a particular view on that, but I think let's look at cost. You basically have three services that you pay for. The first, you pay for advice, and advice can run up to 1% of your investment balance. Secondly, you pay for administration, including the investment administration, the so-called list platforms. There, once again, you can pay up to 1%. And then investors, retail investors, unit trusts, you typically have an expense ratio of 1.5% to 2%, and you may pay performance fees. So if we simply say that you've got potentially up to 4% in costs, 1% advice, 1% for the administration, up to 2% for the investments, then you've got to say, well, am I getting value and can I do it better? Now, often advice is not really advice, because as Treasury has pointed out, people are being advised to invest in the wrong product. So advice can't be working. So it's really, often advice is a marketing cost, so it's a distribution cost. So we can definitely cut advice costs very significantly. The platform fees, the administration, that also should be cut dramatically, because it should be embedded in actually managing someone's investment. You shouldn't charge twice for what is really one service. And then the investments, as Narina has said, there, rather than paying 1.5%, 2% for active management, you can get portfolios with the exact same risk profile for 0.5% or maybe slightly more. But certainly the research is showing you that on average, an index fund outperforms an active management fund. So if you look at those 3 layers of fees, there's a tremendous amount of fat, and there's a tremendous amount of efficiencies